We're not even thinking about raising rates. Changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. I think this isn't the time to be thinking about that. So I wouldn't look for us to be sending signals about cutting back on facilities or anything like that for a very long time. There may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're going to keep our inflation target at 2%. We're going to use our tools to get inflation back to 2%. We think that the economy will need highly accommodative monetary policy and the use of our tools for an extended period. And we're absolutely committed to staying in this until we're very confident that that is no longer needed.
Well, hello there, my friends. Rafi here from the End Game Investor with this week's silver report for Arcadia Economics. And today we're going to start off with a gold shortage in Austria. All coins being produced by the Austrian Mint are already sold out 3 times over, which technically means a shortage, which means that prices are too low. Rumors have it that Putin will respond to the oil price cap this week, which may have already happened by the time you're watching this, which suggests that maybe Zoltan Pozsar is right and he's going to peg oil to gold before the end of the year. I have my doubts, but it is certainly an exciting time. Russia's helping India build enormous tankers to get around the $60 price cap, so it's already moving on that price cap. And while the US may think that Russia will be damaged by the price cap, it's really the dollar that will be damaged more than Russia. The Bank of England needs a $188 billion bailout, as all central banks pretty much are going bankrupt because all the bonds they've bought since 2008 are losing value as interest rates rise. So the more they fight inflation, the more they all go bankrupt and the weaker their currencies become. Ironically, the harder they fight price inflationary pressures, the weaker all the fiat currencies become. It sounds paradoxical, but it is nevertheless true. Powell, Jay Powell of the Fed, is starting to talk about a moving inflation target, and in the silver market, the paper silver investors are still fast asleep. The SLV ETF, the largest silver ETF by far, is still bleeding silver, which means that the paper traders are still out of the game. This week's silver report is brought to you by Fortuna Silver Mines, symbol FSM, just released a press statement saying on December 15th that they have increased their revolving credit facility by $50 million to a total of $250 million. This is if they need extra liquidity. And if you're wondering, the debt to market cap ratio on Fortuna Silver Mines is extremely low at about 10%. The market cap is about 1.11 billion and debt is about 113 million, if I remember correctly. So it's about 10%. And keep in mind, this is with their stock price near the low territory. Let us begin this week's silver report with a look at the paper silver markets, which are pretty much dead in the water, which is a good thing. See here a 6-month look at the SLV ETF. On the top here, we have the price per SLV share. We are now at $22, $21.99 as of, I think, Wednesday, December 14th. You can see what has been happening to the holdings of this fund. The silver holdings of SLV have fallen significantly since July, but especially since the bottom. We have here, it looks like around 466 million ounces, and here we have about 469 million. It hasn't gone up pretty much at all since silver bottom back in September at, 16 and a half an hour at 22. This is a significant rise in the silver price with almost no relative rise in the SLV fund. And in the past 3 days, it looks like we've had almost 4 million ounces drained out. And now here is the really cool thing. This is a long view on the SLV ETF. And here, so you can see what is going on here historically, right? We've had a huge drive higher in SLV reserves here, and the amount of baskets, the amount of silver that's supposedly in the fund. Since March 2020, we had a huge influx, one of the biggest on record. And here, of course, silver squeeze with that huge spike when SLV apparently put in, was it like 140 million ounces or something in a day? Do you really think they did that? Let's just leave that up to speculation, shall we? But here's the point. You see here this pretty healthy rise in the silver price, Looks like we have a head and shoulders bottom here. Here's the head, these two little arcs are the shoulders. So possible head and shoulders bottom here, and then a very strong rise up. So during this rise in the silver price, we've had pretty much no rise in the silver reserves of the fund. Very unlike what was happening from March 2020 through silver squeeze. Since silver squeeze, SLV interest has waned, which means that the paper traders still have yet to enter this market. And so the move, it probably is a long way from being finished in a technical sense. Now let's move to Powell. He's not thinking about something again. Let's see exactly what it was.
Changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. I think this isn't the time to be thinking about that. There may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're gonna keep our inflation target at 2%. We're going to use our tools to get inflation back to 2%.
By thinking about changing the inflation target, not even thinking about it, without thinking about it.
We're not even thinking about raising rates. Changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. I think this isn't the time to be thinking about that.
Now let's move to Austria, where it says, according to Reuters, inflation uncertainty fuel new gold rush at ancient Austrian mint. Key paragraph here: at the moment, every gold coin that comes off the coining press has already been sold, said Starsick. He's the chief executive of the Austrian mint. Right now, we could sell 3 times as many as we are able to produce. That's just another way of saying there is a gold shortage in Austria. If you're selling more than you can produce, then not everyone willing to buy can get what they want, and so there is a gold shortage. What is the cause of this? The low spot price. I'm going to go over one more line from this article and debunk it. This is still Starsick talking, and he says in the final paragraph here, he said he believed more Austrians were seeking to include gold or silver in their portfolio as a hedge against stocks which diversify their portfolios. Many analysts doubt the usefulness of gold to counter inflation, however. And so they gotta stick in that last line, the usefulness of gold for countering inflation. But that whole terminology doesn't make any sense. It is a nonsensical statement. Gold does not counter inflation. Silver does not counter inflation. Inflation is the inflation of the gold and silver substitute on top of the gold and silver supply. So gold and silver are not inflation hedges. They are simply money that is not inflated. So how do you counteract? How do you escape inflation? You get money that isn't inflated by definition, and eventually it pays off handsomely in terms of the real assets that can be acquired. Remember Zoltan Pozar's theory that Russia could peg the dollar to gold as a way to circumvent the $60 price cap on his oil? This just came across my Twitter feed from Financial Juice. Kremlin. Putin decree on a response to the oil price cap is still expected this week. That is December 15th. You're watching this on December 16th, so maybe it'll be over the weekend. Maybe you already said it. Maybe it'll be Sunday. Who knows? We'll see. It's coming up soon. There's something that he's going to be saying, going to be sharing. And if he says that he's going to be trading his oil for gold, it's going to change the world. I don't know if he's going to do it. I doubt that he's going to do it because it seems a little bit too good to be true. There are other concrete moves that Putin is making, and that is here. Russia offers to help India get hold of a big oil tanker so it can dodge the EU price cap rules. How does helping India build large tankers help them circumvent the $60 price cap rules? Well, because the price cap isn't really on the oil itself or on countries that buy the oil. It's not like the US or its allies are going to bomb countries that pay more for Russian oil. It's that the US and its allies are forbidding insurance companies from insuring oil at over $60 a barrel. So they can only insure up to $60 a barrel, and no one's going to transport oil across the world if that supply isn't insured. So by building its own oil tanker fleet, it can insure its own oil without being reliant on US or European companies. And so this price cap, first of all, is encouraging India and Russia to build their own capital system that can trade oil outside of US and US dollar influence. This dichotomy, the two ways of looking at this, is a rehash of the 1960s Keynesian argument that gold will fall to $5 an ounce once the link to the dollar is broken. So in the late 1960s, there were these gold commissions and senators and congressmen asking questions from economists about what happens if we go off the gold standard, what happens to the price of gold. Well, they looked back at the crime of 1873 when silver was demonetized in favor of gold and said, oh, look, silver went down in 1873 when we delinked the dollar, when we severed the connection between the dollar and silver. And so if you sever the connection between dollar and gold, gold will go down too, because if it's not connected to the dollar, which is the ultimate asset in their Keynesian eyes, then who needs gold if you don't get dollars for your gold? But the point is, you don't get dollars for your gold. You get gold for your dollars. So if gold is delinked from the dollar, obviously the price of gold goes up. And they were wrong about that in the 1960s. But it's the same thing here. In the oil dollar equation here, they're thinking in the US and Europe that the dollar is the ultimate asset, that if the Russians don't have access to the dollar, they're going to suffer. But really, gold is the ultimate asset. So if they help India produce its own transport system for oil, building its own tankers, and they have the capital, and they can circumvent the entire dollar system and trade in gold. They should just trade in gold. So never underestimate Keynesian hubris. They think the dollar is the ultimate asset until the end of time when hyperinflation destroys it, and they will go down with the ship as India and Russia build their own. And finally, let's go into central bank bankruptcy land again. We have this new, very thorough and honest article from the Telegraph by Neil Record here. It says, we made an appalling mistake, so the Bank of England needs a $188 billion bailout. As interest rates rise, we're about to suffer the consequences of a decade of reckless spending. Now listen to this. This guy, Neil Record, made his own math here, trying to figure out how big of a hole is on the Bank of England's balance sheet. So he says here, I have used the published list of gilts, those are British bonds, from the APF holds. The APF is the subsidiary that holds these bonds by gilt, coupon, and maturity, and have calculated somewhat approximately but broadly accurately the effect on the APF's gilt value as versus gilt yields. The graph below shows the results. So here we have a 3.5% interest rate, and the value of the gilts on the balance sheet sees a loss of 3.5%, a loss of about 188 billion pounds, and that loss gets greater and greater and greater as interest rates rise. To help the layman interpret, he says, the chart is telling us that the Treasury now has to bail out the bank to the tune of around 188 billion at today's 3.5% 15-year gilt rates. You see here that central banks across the Western world are indeed going bankrupt. The Fed is losing money. It is printing money to cover those holes. The Bank of England is losing money. It is printing money to cover those holes, and you have completely unbacked currency starting to circulate in the monetary system. At some point, a wire is tripped, and there is a run on these banks themselves. The bailouts since 2008 have taken all the bad assets that have accumulated during this fiat system all the way back beginning in 1971, or maybe even earlier if you want to count from 1934. They've taken those bad assets and they've put them on the balance sheets of the central banks, which are now stuck with them. They cannot offload them onto anyone else because they are the currency creators themselves. And those bad assets are starting to rot now on these balance sheets, and they are losing money and printing it to plug up those holes. And when that happens, you have the process of hyperinflation. It's unavoidable now. It is only a question of when the wave hits. And when it does, as we are seeing in Austria, a gold rush that is mostly by wealthy people, the public, which is not so wealthy, is going to wake up as well. And they're not going to chase gold. They're going to chase silver, which is why the ratio is going to fall back to 15-1. And it's the silver stackers that will save the monetary system, and only secondarily the gold stackers. Hope you enjoyed this week's Silver Report for Arcadia Economics. You can always sign up for a 2-week free trial of the Endgame Investor or become a patron on Patreon, where you will get a weekly video of biblical commentary on economic and monetary policy topics. This week, we're going to go into the first monetary currency system that was established back in Genesis for the people of Shem. What does that mean? I guess you'll find out. In the meantime, keep smiling, keep stacking, and stay calm.
We're not even thinking about raising rates. Changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about.
I'm only going to say this one more time, sir. Calm down.
I'm calm!